While it was a shock, it is a good example of democracy in action, which is something to be celebrated regardless of one's view of the outcome. It is also important for investors to be aware that it is not a major global financial shock. The UK economy is only 2.5% of the global economy, and global banks are not insolvent because of this. And while global stocks have moved down by the gravitational pull of Brexit, it is a localised political shock as opposed to a major global financial shock. We were maintaining a low equity position, moving into bonds based in Australia and holding property and infrastructure at relatively high levels. We also held high levels of cash awaiting the outcome of the Brexit vote. The funds we were invested in had also positioned for this uncertainty, holding higher than normal levels of cash. This cautionary action from both us and the fund managers has benefited the portfolios. We can now look to buy back into equities at these lower prices, as we believe markets are functioning well, banks are better capitalised, and authorities have much more experience with disruptive events. Furthermore, we have seen that quality investments generally outperform in this environment. It is only normal based on history that we will get some lower return or negative periods. We need to manage the risk during these periods and be ready to maximise gains in the periods of growth. We would expect markets to remain volatile over coming weeks as we learn the next steps in the UK's process. Volatility will reduce over time as investors realise the global and economic financial wheels just keep on turning. And remember, no one has a crystal ball. The key thing is to remain diversified and continue with one's investment strategy. Historically, investors who abandon their strategic asset allocation tend to do worse than those that don't. While this tests investors' nerves to the core, it has historically proven to be the correct decision.